We do indeed, and I am happy to introduce Ryan Jones. He's the owner of Quantum Trading Strategies and one of our sponsors today. Ryan has been trading since he was 16, a whole 10 years. Just kidding, Ryan. Anyway, he is one of the youngest authors ever to publish a book in the futures industry, and he also turned 15,000 account into over 107,000 in less than 90 days. Short-term trading, the S&P. This is a real money account. So Ryan, Raleigh is going to introduce you and specifically go over what you're going to speak on today, and we're hanging in here just so we can, heckle you where needed.
That sounds great. We are delighted to have Ryan with us. And today his topic is going to be never again fear a stock market crash. And the things he's going to be covering is the importance of properly hedging your market position, why there really is no perfect daily hedge technique, and his favorite strategy for making a killing if stocks should crash. And with that, I'm going to pass things over to you, Ryan. We're delighted to have you with us. You can grab the screen when you want and take her away.
Great. I am grabbing the screen as we speak. And let's see here. All right. So let me know that you can see the screen. Obviously should say Wealth Builders on it.
Yes. See the screen, hear you loud and clear. Take it away, buddy.
Good to go.
Perfect. All right. All right. I'm gonna take my video off so that everybody's not distracted. And that will help with a better vision of the slides as well. So I have a lot to cover today. Of course, the presentation is called Never Again Fear a Stock Market Crash. As Pat said, I've been doing this for years and years and years and years. There is, if I talk fast, please forgive me, but it's because I have so much to cover and so much to say, having done this for so long. It's hard to fit in everything in 1 hour. I actually have I've done 140 hours worth of trading educational material on everything, every major approach that you can imagine. So what I'm going to do in today's presentation, I'm going to reveal how to hedge any portfolio, any stock portfolio against the stock market crash. And I'm going to show you how to put yourself in a position to consistently beat the market with a fraction of the risk exposure. And I think this year is going to be an interesting year. Maybe the next couple of years should be an interesting year in stocks. And I think this is a really, really well-timed presentation because I think people definitely need to know how to hedge. And I'm going to start with why do you want to hedge? And there's more reasons than just fearing a stock market crash, actually. So the first reason is because the long-term growth is far more exponential with an aggressive investment approach. So what do I mean by an aggressive investment approach? Well, if you are able to average 10% annually, which is just about what the stock market has been averaging over the last 20, 30 years, 10% annually, you're talking about taking a $100,000 account, and in 20 years, you're able to compound that into almost $670-ish, $700,000 dollars, depending on the exact average annual return. Okay, so that's pretty good. But if you can increase your average annual return to 15% instead of 10%, you're talking about that same $100,000 growing into about 1.7 million, as opposed to just 600,000 or 700,000. And if you can go just 5% better than that, and if you can average 20% annually, you're talking about a $3.2 million difference by being able to grow your account to about 3.9 million. 3.9 million in 20 years. So it is very, very important to focus on being able to achieve these higher returns if you are all able to. The issue, of course, is the fear of a stock market crash. You don't want to be too aggressive, because if you're too aggressive, then you're going to get really hurt. And that is exactly how it works too. Market corrections kill long-term exponential growth rates. So just to give you a visual on this, this is SPY is in the red, and it's the return from 1997 to 2012. And you can see really there's not a lot of growth overall between those years, because there were two major corrections. and those corrections stunted the overall return. But in the green line is based on hedging and being able to avoid most of the drop during those major corrections. And you can see that if you are able to hedge, then when things start picking back up again, the overall net return is about threefold what it is if you just have a stock portfolio and you go through these hedges. So you just buy and hold, like everybody says. You don't do any type of hedging, and you're going to leave a lot of money on the table. Okay, $1,000 invested in S&P in 1995, avoiding the major market crashes all the way up to and including the pandemic crash of last year. You're talking about approximately $10,000, $11,000, and after going through the market corrections. If you can avoid the market corrections, you're talking about $30,000. That's about a threefold difference on your return by being able to avoid the market crashes. So again, when you talk about the compounding, it really, really starts to add up. So if you can use the hedging to avoid the crashes, it's not just about avoiding the crashes, it's also about increasing the long-term exponential growth. So I'm going to talk about some of the hedging strategies that are common because I think there's a lot of mistakes, a lot of misinformation, and quite frankly, a lot of people that don't know what they're talking about out there on the internet. And you'll see hedging strategies in a lot of articles, websites, blogs, and they look like something. They look something like this. You know, if people are starting to get a little edgy about the stock market, they'll say, "Well, you want to put a portion of capital in cash," or they'll say, "You want to buy gold or silver." How many have heard that one? That's a really popular one. Or you want to invest in a bearish ETF. That sounds really smart, doesn't it? Or you want to time the market, and timing the market is quite common in trying to avoid a market crash. Other strategies are including cost averaging when the market moves down and buying puts. Okay, so these are all things that you're going to find on the internet, and they're under the topic of hedging. But the problem is that most of these are not hedges at all. And in fact, they don't even make any logical sense if you really start to think about it. So for example, let's talk about putting a portion of your capital in cash. What does this mean? It actually means that you have to time the market. It's you have to time the market. You have to figure out when the market is going to crash. And you know what? I've been doing this a long time, and I have yet to meet somebody that can time accurately the market corrections and not be off by a long time period. Like they'll start saying, well, we could start to crash now. We could start to crash now. Well, 2 years later, it crashes. See, I told you 2 years ago we could start to crash. Well, in the meantime, you had your money in cash and you lost about 20% in gains, right? So it's not a hedge. It's timing the market, and it also diminishes returns if you're wrong. So the next one is buy gold or silver. And buying gold or silver is not truly a hedge against significant market corrections or a market crash, and in fact can counter any gains in stocks. There's just not an accurate absolute correlation between stocks and precious metals, although a lot of people like to think that there are. So for example, in 2011, starting in 2011, you can see that Spider Gold, which is in the purple or blue, however your screen looks, actually is moving down while SPY was moving up, right? So it does counter some of that. But notice back in 2008, during the market crash of 2008, financial crisis that we went through, gold was down. So it took a while for gold to start moving up, but when it started moving up, stocks started moving up as well. So it's not an accurate hedge, and you cannot rely on it on a one-to-one. So the next one is invest in a bearish ETF. Oh, another one that sounds great, like really smart. It's utterly unnecessary though. If you invest 10% of earnings in a bearish ETF, the net result is exactly like having 10% less invested in the stocks, with one exception: you won't collect dividends, right? So this is really, if you're going to go into a bearish ETF, it's like putting half of it in cash. I mean, that's all it is because you're just offsetting some of the growth with losses in the bearish ETF. If you start to think about these things, it amazes me what people will put on the internet. Nonetheless, next one is you need to time the market. And of course, I've already covered that in just a little bit, but it's not a hedge and it lacks efficiency and it requires a lot more on your part as far as understanding when the market might turn or when it doesn't turn. I'm going to give you, I'm going to throw this in here. I'm just throw it in here for free. The majority of the market movement to the upside, the majority of the returns in SPY over the last 30 years is based on the first calendar day of the month. And I think it's like 85% of the returns can be attributed to the first calendar day of the month, right? So if you want to do timing the market, you need to do stuff like that. And that's going to lower your risk exposure dramatically. But other than that, timing the market, it's not a hedge and it lacks efficiency. Okay. The last one is cost average when the market moves down, or the last one that I'm going to rip to pieces, if you will. Cost average when the market moves down requires you to come up with more money. How is that a hedge, right? If you're losing money, where are you going to come up with the extra money to invest when stocks are down? Well, the presumption is that you got out before stocks moved up, you moved into cash, and then when stocks moved down, you move back into stocks. Well, sorry guys, that's just not realistic for most traders. And so it's not really a great hedge or a hedge at all in many cases. And in some cases can actually cost you a lot of money when you're wrong. All right, so that leaves us with the last one. And the last one is buying puts. And the issue with buying puts is that they're generally expensive. And so let's say I have a $50,000 portfolio and I want to hedge. So I begin looking at SPY puts. That's about $37,500 value. It's actually a little bit more now, but about a $37,500 value. If let's say you have a stock portfolio that's very similar to SPY, very correlated to SPY. Well, in that case, an at the money SPY put that expires in approximately 3 months out is going to cost about 2%. 2% for 3 months. That's 8% annually, making buying puts effective, but inefficient. Because if you're wrong and the market doesn't move down over the next 3 months or year, and you continually do this, you'll have to make up that 8% cost by the movement in the stocks or your strategy or whatever it is that there is. So there are issues, but out of the list that I just gave you, buying puts is the only truly effective way to truly hedge against a stock market crash and or major market correction. Or something similar. My favorite hedging strategy, which I'll present as the last strategy here in a few minutes, it's actually not buying puts in SPY or one of the stock market indexes, but nonetheless, it is the most effective means for doing it. So this is just a starting point for hedging, okay? You do want to buy puts or a similar strategy, but that's just the starting point. If you just leave it at that, you're better off most of the time not hedging. And I'll just throw that out there. So this is the starting point, and you need to make sure you understand this, okay? Buying puts provides insurance, but let me tell you about insurance. Insurance companies that sell insurance are generally very profitable. And that's because insurance pays, right? So here's a chart of Progressive Insurance versus SPY since 1999 to present. Actually, it's about a year ago. And you'll see here that Progressive outperforms SPY tremendously by about threefold. And of course, Progressive is an insurance company, and I'm telling you, insurance pays. So the one thing that I do every time I buy something, and they offer a warranty, so I'll go and buy a TV or whatever, and they offer a warranty. I decline the warranty, and I put that money in an investment account to be used when one of the things that I buy that they all offered warranties for, cameras, electronics, appliances, whatever it is, they offer warranties. I put that money in an investment account. And then when one of those items eventually does break, then I pay for it out of that account. And guess what? I'm self-insured, right? You'd be shocked at how much you can put away over time versus how much you actually use these funds for on this insurance, right? So one very important key ingredient that is missing from simply buying puts is, and that is what leads me into a few hedging strategies that I'm going to be talking about, because you have to have this ingredient if you're going to do it. So before I get to that ingredient, let me give you the context of these hedging strategies. I don't want to get too deep into the weeds, but I do want to show you that there's no stone that I've left unturned when analyzing how to hedge a portfolio, and I'll talk about that here for just a few minutes. So what can these protection or hedging strategies that I'm about to give you be used for or be used with? And these, I kind of got to tell you what they cannot be used for, what they should not be used for. And the first thing is that they should not be used for stocks with less than 100 shares. So if you have a single stock and you want to hedge that single stock, but you have less than 100 shares, you have to be very careful with how you do it. Okay, so that's the first thing. The second thing is stock portfolios that have little or no correlation to the S&P 500 or any broad market index. You might be more correlated to the Russell, you might be more correlated to the Dow Jones, you might be more correlated to SPY, but there has to be some correlation. If your stock portfolio is not correlated to one of those or all of those in some way, then you have to be, again, very, very careful about what you do. Okay, so these specific hedging strategies are best used with sufficiently diversified stock portfolios that have a general correlation, not exact, but general correlation with main stock market indexes. And they are not made up of risky, unproven companies. Okay, so that's key. All right, if you've got that covered, a good hedge starts with a solid portfolio or a solid strategy that is similar to having a portfolio. And these are the specific hedging strategies that are best used with sufficiently diversified stock portfolios that have general correlation with main stock market indexes. So it's the S&P 500, the Russell 2000, Dow Jones, and then the small cap QQQ is also available on here. Okay, now you also need to understand there's no perfect daily hedge strategy. Okay, you're not going to have a perfect daily hedge strategy. Market might be down. Your portfolio or whatever strategy you're using might be down 1% one day, and your hedge is also down 1%. Or the S&P 500 might be up 2% one day, and your portfolio might be down 1.5%. So these hedging strategies do not hedge against normal daily variations between individual stocks and the S&P 500. One stock, for example, if you have a portfolio, one stock can dominate the daily performance. Here's one where I was in a Kohl's, and Kohl's was down 7% one day, and that kind of dominated the rest of the portfolio. And even though stocks in general were up, my portfolio was down because of that situation. You're not going to be able to avoid those. The hedging is to avoid the major market corrections. That's really what it's for. Okay. And on the flip side, the following day, this particular portfolio was up 2.3%, while SPY was down 1.13%. So it goes both ways. You just can't expect that granular of a hedge. That's not how it works. So short-term non-correlations can and will cause divergences in daily stock portfolio performances versus the S&P. And sometimes to the positive side, sometimes to the negative. That's basically what I want to drive home on this as far as expectations are concerned. Then these hedging strategies will not hedge against individual stock positions unless applied to individual stock positions. So Tesla recently became part of the S&P. So there's a little bit more correlation there. But if you have a big position in Tesla, I would hedge Tesla individually. And I would use these strategies to hedge Tesla. And so that just kind of gives you an idea. Here's an example of Boeing. And there are times when an individual stock will be correlated with the broad market, and then there are times where it won't be. So this is between March 2011, December 2011. You see that there is a very strong correlation, and Boeing ultimately did outperform SPY during that time period, but as a general rule, there was a correlation in how those moved. And then you have between March 2014, December 2014, and you can see here that this is one where Boeing actually outperformed SPY significantly during a bullish period. And then here's January 2014 to October 2014, where Boeing actually underperformed. So the correlations, again, the short-term correlations, you need to be aware of those. And if you have a big position in a specific stock, you may want to consider hedging that stock outside of the overall correlation. And now these strategies can also be used with a diversified put selling strategy. And that's really where I'm going with this ultimately, because this is how I use these hedging strategies. I have been selling options for, I would say, since 1992, I think was my first year that I sold options. And it is a tremendous approach if you know how to do it. And it becomes even more tremendous if you know how to hedge. And so these hedging strategies, absolutely. If you've never considered put selling before, you have no clue what you're missing. And when you combine it with the hedging approach, I think it takes away most of the fear that people have when they sell puts. But you have to understand that selling puts is nothing more than buying the stock at a lower price. That's really what it is. If you're going to allow yourself to be signed, if you buy an out of the money put and the market moves down to where that becomes in the money, then you're going to be assigned. And you're going to be signed at a lower price than if you had bought that stock, right? So there's really no additional risk outside of that. But because of how you can structure the trades, you can create some really high probability returns. So for example, my main put selling strategy is called hyper options. And right now we're on a current winning streak that goes back to August of last year, 67 winners in a row. And those are actual fills, not hypothetical. And those are all public, not public, but subscription signals. So it's not just me saying, it's me showing and subscribers following and being able to verify that. Okay, so despite the high probability of this strategy, I still use my favorite hedging strategy to protect it in case of a severe market correction and or crash, because even though I have a really high probability, if the stock market crashes, it will take my portfolio down with it. It just won't be down as much as stocks crash. And if I'm implementing a hedging strategy with it, all the better. So what is hyper options? Is really quick. It's basically a high probability above average returns, which also naturally provide resistance, not immunity, but resistance to a stock market crash in and of itself. And the reason it does this is because you can sell deep out of the money puts that provide significantly above average annualized returns. And if you're going deep out of the money, that means it requires the stock to make a significant move down before it goes in the money. And this is how it provides resistance to a stock market crash. Because if I'm selling puts that are 25% out of the money, the market has to drop 25% before it goes in the money. So I'm not losing 25%. In fact, for me to lose 25%, the stock actually has to drop 50%. And that's provided if I'm not a hedge, right? So that's how it provides resistance to a stock market crash. And you can kind of determine by the trades that you put on how much resistance that you can provide. So I'm going to show you an absolute no-brainer trade that we took. In fact, I recently read an article about put selling that said if you see a 95% probability in put selling, it's probably too good to be true. And the guy didn't know what he was talking about, because this was a 99.81% probability trade. And this is not by my calculation. This is by Interactive Brokers, TD Ameritrade. They're the ones that showed this as a 99.81% probability of success. And this is what it was. We were short. We did, in this particular account, we did 100 of them. American Airlines, we sold January 21st, 2022 puts. That was over a year out. We did this in October of last year. And we sold $1 puts for 18 cents. Now, the thing with this trade is that the market was trading at $12 at the time. $12. So the market would have had to drop from $12 to $1 just to put the strike at the money. And we sold it for 18 cents, which means that our break even was 82 cents. And we were only risking $82 per trade if it went to zero. Ridiculous trade. The key, though, is that we don't hold on until expiration. We actually exited 3 months later, less than 3 months later, and captured a majority of the profit for an annualized return of 77% on a 99.81% probability trade. That's how crazy it can get if you know what to look for and you know how to take advantage of them. And that's what hyper options are. But the average, that's kind of an outlier. The average option puts are out of the money by an average of about 25 to 50%, meaning that if the stock drops 25%, the put is still out of the money. Obviously, if I sell a put that's 50% out of the money, then the stock has to drop 50%, right? So just to hit the strike level. So you can create some pretty high probabilities. Now, if you add a hedging strategy to this type of approach, the long-term compounding effect can be ginormous. You can easily max the risk out at 30%. You can say, you know what, I don't want any more than a 30% maximum risk exposure without hedging, and require the stocks, all the stocks that you're in, to go to zero before that ever hit, before that 30% ever hits. And you can make about 20 to 30% average annual returns while never having a maximum risk exposure of more than 30%. And that's without the hedging. So this is a no-brainer. In my opinion, anybody that has a stock portfolio, if they're not doing this, they're missing out, because the long-term compounding effects, especially when you add in the hedging, can be ginormous. All right, so that brings me to my my actual hedging strategies. I want to give you a broad overview of what they can be used for, how I use them. And of course, what I said, the starting point, not the ending point, the starting point is buying puts in broad market ETF, but you need to make sure that you're doing this the right way. And so there are two things that you want to look for to determine which ETF you want to buy the put in. Obviously, if it's correlated to one ETF more than another, then that's kind of a no-brainer. But if it's just kind of a general correlation, then you're looking for the ETF that is the weakest. In other words, the one that's going to sell off the most in a broad market crash is the one you want to buy puts in. If that is something that is predictable, if you will. Now, there are only four major ones basically to choose from, and that's SPY, QQQ, IWM, and DIA. There are others. You can be more granular with it, but these are the four major ones that have most volume. Options are weekly options, and so you can be really granular with it. And you'll notice here that SPY is in the red, QQQ is in the blue, Russell 2000, IWM, that would be in the green, and then you have the Dow Jones, which is in the pinkish. Right, and so you can see they're all correlated to some degree, but some are weaker than others at times, and some are stronger than others at times. And this is from 2000 to 2019. So overall, when you see weakness, the weakest one was actually QQQ, right? But if you kind of look at 2007 to 2019, as opposed to 2000. Going back all the way to 2000, you have a little bit of a difference going on here. And then I also have the SP Ultra S&P 500 in there as well. And you can see here that since 2007, QQQ has actually been the strongest. And the weakest has actually been the Russell 2000. And that tends to be what we see over time, is that the green is the Russell 2000 is when the market comes down, the Russell 2000 tends to come down a little bit more. And this is the 4 major players in the market crash of 2008-ish. And when everything went down about 40%, you can see that the green is ultimately what went down the quickest. So if you want to be that granular, you can certainly do that. And that's something that you can do to choose which one you want to hedge in. So the weakness favors IWM, but what about the hedge cost? So it's not just about the weakness, it's also about the hedging costs. And the hedging costs in buying puts, if you're going to do at the money, I've kind of broken it down. This is generally, and this is when the market is at higher levels. If you try and do this after the market tanks, you're in trouble because the volatility will spike, the options will become very expensive, and you won't be able to do it. You'll probably end up losing money. So hedging needs to be done before the market correction. Very, very important key there. Nonetheless, look at the costs. Over a 3-month period between IWM, SPY, QQQ, and DIA, you can see that it's all just around 2%, just over 2%. And so there's not a whole lot of difference there. If you look at the 6 months, meaning you buy a 6-month put, not a 3-month put, then the total cost comes down a bit as far as the average is concerned. And then if you go 9-month put as opposed to a 3 or 6-month put, you can see it comes down a little bit more. And then at a 1 year, obviously that's the cheapest. As far as the long-term put is concerned, there are issues though by doing 1-year puts, which we'll talk about here in a second. So cost to cover a $100,000 portfolio with at-the-money puts. This is what it's going to cost. About $2,700 in IWM for 3 months, $2,200 in SPY, $2,800 in QQQ, and $2,100 in the Dow Jones Industrial Average. So whichever one you choose, that's about what it's going to cost. 6 months, 9 months, 1 year, you can see the cost there. Of course, if you're to do 3 months 4 times, you're looking at about 10 grand to cover a $100,000 portfolio. It's not very good. In fact, it's awful. All right. So it breaks down to weekly costs, and there's a reason I want to do this. The weekly cost to cover a portfolio with the at-the-money options is about $225 in IWM for 3 months, $164 for 6 months, $139 for 9 months, and if you go and buy the year, it comes out to only $131 per week. That would be the weekly cost if you were to buy a 1-year at-the-money put option. Okay. So I'm just giving you some comparisons of things to think about as we go through and I complete this strategy. So why not buy the 12-month puts at a lower cost? Well, the reason is because if SPY moves higher or your stocks move higher, you will eat the bigger option premium and you won't hedge against any gains that are made during the year. So if I buy, let's say the market's trading, what, 385 today? If I buy a 385 SPY put, that's a year out. I pay less on a weekly basis for that. But if SPY moves to 450, guess what? I'm not hedged from 380 to 450 or 385 to 450. So that is the issue with going 1 year out, and makes it to where the 3 month is a little bit more palatable as far as that's concerned. So SPY moves 10% higher, your put is no longer at the money. It's actually out of the money by 10%. And it is devalued accordingly. So you'll not only see it devalue based on time, you'll see it devalue based on price action as well. So one way to drop that is say, okay, I don't want to be fully hedged based on where the market is at. I want to be hedged if the market drops more than 5%. That's when I want to start to insure my portfolio. And there you bring the cost down quite a bit. And you can see the costs go from like $200 a week to almost half, $95 a week, just by going 5% out of the money. And so that's something that is much, much more palatable. And you shouldn't be worried about 5% variations in the market anyway, right? So that's kind of where I steer people. But once you determine how you're going to buy the put, this is the key ingredient that is missing from most everybody that talks about hedging. And that is, you don't want to just eat the cost of the hedge. You do not want to just eat the cost of the hedge. You want to find a way to pay for that cost, or to mitigate, at minimum, mitigate the cost of the hedge. That's where this is really, really valuable, is when you learn to do that. So to give you an example, we need to bring in to do a 5% out of the money hedge on a $100,000 portfolio. We need to bring in or find a way to pay for about $87 a week to completely pay for the insurance. And again, you don't have to completely pay for it. If you can just mitigate the cost, let's say by half, you'll drop your long-term costs from about 5% to 2.5%. And that's much more manageable. If you can pay 2.5% to hedge against a market crash, that's not bad. Okay. I prefer to try and do all of it. And these are strategies that you can use to do that. You can sell out of the money or at the money weekly calls in SPY. And I'll talk about that. That's a really good one. You can sell out of the money weekly puts in SPY. And that one's not one of my favorite ones, but it is definitely something that you can consider. You can sell out of the money calls and or puts in another ETF. So you don't have to do SPY. You can do it in IWM. You can do it in QQQ, whatever has the highest price calls, as an example, based on the value of that ETF. Then you can choose one or two of your bigger individual stocks and do the same thing with that. Selling a call, an out of the money call, short term out of the money call, and use it to pay for the entire hedge of your portfolio. There are some individual stocks that can do that, Tesla being one of them. You can go way out of the money with Tesla, give yourself plenty of room for growth, and there's so much premium that you can bring in that you can almost pay for the hedge of your entire portfolio by doing that. But you have to make sure you have the stock first. You don't want to buy out of the money calls in a stock you don't have. Period. End of story. You don't ever want to do that. So I want to make sure that you understand that. All right. So obviously, then you can do a combination of the above. And I'm going to kind of keep it simple here. And I'm going to give you some examples of selling an out of the money or at the money weekly calls in SPY. And the key here is that you go out and you buy a longer term put option. That's say 5% out of the money. And you may buy 3 of them, for example. If you're going to hedge a $100,000 portfolio, you need to buy about 3. But then you can turn around and you can sell weekly out of the money calls. And over the course of time, you can more than pay for the cost of the put. So for example, here is an example, and this was done back in, I think, January 15th is the example of this particular hedge. Total cost for the week is $940 on this particular trade. And what I did is I bought the hedge, which was a April 16th, 356 put. And at the time, that was 5% out of the money. And then I started selling out of the money calls. Market was trading around 375 at the time. And I sold a weekly 380 call for about 113. Okay, so if the market moved up in 1 week, guess what? I would be able to collect that premium and do it again. I'd collect the premium. I'd collect the 5-point move to the upside in SPY with regard to my other stocks, and then I would be able to do it again. And so I would be able to whittle off the cost of that put option that I'm using as a hedge. And if I were to do that every week, if I were to bring in $1.15 every week up until the end of the hedge, which would be April 16th, so we're still not even there, I'd actually realize an annualized return of about 16.9% by doing it that way. And so it is a very effective way to be able to pay for the hedge. And it actually, in some cases, allow you to do more than pay for the hedge by doing it and keep you out of the money so that you do have some gains that you can make in your portfolio as well. So if you bring in $1.15 for 12 weeks, that's $13.80. The hedge put costs $10.50. And so net, you would make $3.30 in this hypothetical situation. There actually, you actually have a higher probability of doing it than that if stocks are stagnant. But that goes into an area that I don't have time to go into in this presentation. Nonetheless, if you can make 3% annualized return and have a hedged portfolio, that's pretty good. The downside is that you are limiting the increase potential of the stock portfolio overall. So it depends on how far out of the money you go. Now, I don't have time. There's another strategy. It's called a synthetic hedge stock portfolio. I don't have time to go over that, and I apologize. So I'm going to have to skip over that and move into some more ways to pay for the hedge, because that's really the most important aspect to this. And so here is a $100,000 example of portfolio that requires 3 puts, and that is equivalent of hedging $112,000 in SPY. Okay, if you were to buy per quarter, that's $4,800 if you do 3 at the money puts. Okay, but notice that if you do 1 at the money put, it's $1,623. If you do 3, it comes about to be about $48 total. But if you were to sell 1 at the money call, actually at $379, you're talking about dropping the price of that almost immediately by $3. Right, so it can be you can do the same thing with the at the money as you can do with out of the money. And so you can sell an at the money weekly call per $100,000 portfolio that's hedged, and you have the potential to almost completely pay for that hedge. The key here is that you only do 1. If you're going to do at the money, you're limiting your growth potential in the portfolio. So in this example, if I do 1, I'm actually only limiting 1/3 of my portfolio, or the growth potential. I'm limiting 1/3 of my portfolio's growth potential, as opposed to the entire thing. So it's important. I have 3 longs and I sell 1 call. That's at the money, and I bring in a lot of premium for that. Okay, so that's one idea. And there are many, many, many variations of that. I wanted to give you the basis of it before I get to what is my favorite hedging strategy. But, but there is a but with my favorite hedging strategy. And that but is that it's not a pure hedge, and there are other risks that have to be accounted for when implementing it. However, it is also one that you can actually make a small fortune in if stocks crash. And I apologize, I have to move through this fairly quickly. But the pros are that it's cheaper than standard hedging strategies. It's more efficient than standard hedging strategies during a crash. And you can make a short-term killing if markets tumble. The cons of this are that it's harder to time an exit during the crash. So when do I want to get out? It suffers from what's called massive backwardation, and you have to make sure that you pay for this. So the pay for piece of this approach is really important, and it's not a perfect hedge. All right, and so let me just talk about the massive backwardation real quick. If you don't pay for the hedge, what this basically means is that stocks remain the same. This particular ETF continues to drop. And so you don't want to get greedy with this trade. You could lose a lot of money that way. And what it is, instead of using SPY, IWM, QQQ to hedge, then what I do is I actually use a leveraged volatility ETF. And that leveraged volatility ETF is UXVY. UXVY is a 2 times leveraged ETF invested in volatility futures. And the way that it works is that they buy 3-month out futures in volatility in the VIX, and then they hold until expiration. And that's what creates the backwardation, or the contango, if you will. You'll see the price for May at the time was $26 in VIX, but the cash price was $22. And what happens is, as time goes by, the the further away contract eventually makes it down to the cash. That's it in a simplified nutshell. And so you have to take that into account. That's why you absolutely want to pay for your hedges when you use UVXY or UXVY, excuse me. And it's because of that. And in fact, if you were to hold UVXY long term, because of that backwardation or the contango, you would lose 100% of your capital over a pretty short period of time when stocks are stagnant or moving higher. So this is just from March of 2014 to December of 2016. Just under 3 years, you're talking about losing 100% of your capital, almost if you're in UXVY. I show you this to make sure you understand you want to pay for these call options that you're going to buy and use these as a hedge. So long term, if you hold UVXY, you're going to lose 100% of your capital. And you got to make sure you understand that. Okay. Moreover, March 2018 to December 2020, you see this spike here? That is UVXY during the crash. And you'll notice that it barely made it above its high of a year and a half before that. So this is something, again, just making sure everybody understands that. As stocks move up or sideways, UVXY does move down. Your calls will not work. So that makes this to where it's not a pure hedge, and it is a reverse correlation, which means you're going to buy calls. And I'm going to play similar option strategies to capture huge moves in stocks if they crash using this approach. So why not use bearish SPXS, 3 times leverage, similar type deal? Well, it's because if stocks drop 35%, SPX moves up higher by 110%. Okay, this is the bearish 3 times bearish stock ETF. If you're using options in that, the market will move up if the stocks crash. However, what happens is you're talking about massively expensive calls, and you're going to be paying a lot of money for these calls. Generally, buy price 3 months is going to be about $500, and it's not going to cover a whole lot because of the price of SPXS is pretty low. And so you have to account for the correlation. You would actually need 4 of those calls in order to hedge just a $37,000 stock portfolio. That would cost you about $2,000. That is insane. So that's one reason you don't want to use SPXX. The other reason is because UVXY will absolutely blow SPXS out of the water if the markets crash. And so here's the pandemic crash. Market's down 35, 40%. You'll notice that UVXY actually hit 900% return. 900% at its peak. That's why I use UVXY, because the volatility, it will absolutely skyrocket. So if stocks drop 35%, UVXY can move up approximately $135 a share, making a call, this particular call, an $11 call, worth $124 for a gain of $12,100 on a buy price of approximately $300. That's why I use UVXY. So you need 1 call to hedge a $37,500 stock portfolio in theory. Again, it's not a perfect hedge, but in theory, that's all it's going to cost. And this is, again, was back in January as about a 2-month hedge, cost $300. But I'm going to skip part of this and talk about how to pay for that. Did you know if you buy a call in UVXY, which you absolutely have to pay for, that a single 1 week at the money call in SPY could pay for the entire hedge for 2 or 3 months? A single 1 week at the money call. So you can literally pay for the entire hedge in 1 week by doing UVXY and using that particular approach. It is a tremendous, tremendous, tremendous way to hedge your strategy as long as you are paying for them. If you go a little bit shorter term, you need to bring in about $43 a week as opposed to $100 a week. and a single week of ATM call could pay for the hedge. Here you can see that the UVXY cost about $1.72 for a $10.50 call. That's at the money at the time, and it was about a month. And I could turn around and I could sell a 380 out of the money call 1 week in expiration for $1.85, completely pay for the entire hedge with one call. So in 120, as long as SPY is below 380 on 122, I'm done. I've paid for the hedge. I don't have to pay for it anymore. I've got a free hedge at that point. Or I can do a 219, 393 call in SPY. So that's the same expiration date, right? Same expiration date. And I go way out of the money, even further out of the money. And I pay for the call again through that way. So tremendous, tremendous, tremendous way to actively hedge a market as long as you are paying for it. So hopefully that gives you some great ideas. If you don't find a way to pay for it, you have to assume that you're going to realize the max loss on this hedge, and that's going to be about a 5%, 5.6% cost on average if you do it that way. All right. So how can you get involved? I want to just talk about for just a couple of minutes how you can get involved in my hyper option strategy approach, where I use these hedges the most. And the hyper options, again, is the strategy that I have. I'm currently at a 67 winning trade streak in a row, going back to around August. And what I do is I provide signals for those exact signals, and I also provide 1 month of hyper option live trade webinars, and I do those twice a month. So you literally get on a webinar with me. I talk about the trades we're in. I talk about the trades we got out of, and I show you the process I go to pick new trades, and then you get the exact signals. And I'm taking every single one of them, and actually I do way, way, way more than what you see with these signals, because it's just a tremendous, tremendous approach. Plus, if you do want to do more than the signals, you learn how. And I give you a hyper subscription to a hyper option scanner, and you'll be able to scan for other opportunities that meet the criteria that we require in hyper options. So you can take advantage of that. It's only $97 a month, and you do that by going to the link westmarktrading.com/Jones, where you can call Spring at 918-203-7547. And I'm going to throw something in here as a bonus. If you take advantage of it right now, I will throw in my C4 strategy subscription as well. And that one is, I almost hesitate to say anything about it because it is absolutely mind-boggling what you can do with this strategy if you approach it right. And what we do with C4 strategies, we actually buy weekly at the money put credit spreads on stocks that are priced near or below $10 a share at significant annualized returns. And we do this for one reason and one reason only. And that reason is because the price of the stock can't go below zero. And we actually leverage that one fact in our favor to be aggressive with how we put on these credit spreads. These things can produce 1,500% annualized returns. And you have a scenario where you are almost assured you can't lose the maximum risk, which is only like $100 to $150 in any given week. You can't suffer that more than 4 weeks in a row in any given stock because of the zero factor. We leverage that zero factor. It is a tremendous, tremendous approach, especially for small accounts and especially for compounding. And so what I'm going to do, if this is all about the wealth building, and I'm going to throw that in for free. The C4 strategy, I do the signals. I do 2 live trade webinars in that strategy as well. And I also have a C4 strategy scanner. I'm going to throw those in there if you do that today. And I'm also going to throw something else in there. So if you click on the link, you'll see what else is included. I leave no stone unturned. If you want to build wealth, this is the way to do it. So hopefully it is something that I will see you get involved with. All right. Were there any questions? I know we're running a little bit behind. There's a lot to cover. Any
Yeah,
questions?
well, Ryan, once again, you did a very, very thorough job walking through things step by step, and you said it was going to be an awful lot of information. Congratulations, you did a fantastic job with that. There were a couple of
Thank you.
questions that kind of came up that were sort of interesting as people were sort of absorbing what you were talking about, and several people wrote, the one guy said, so if you sold the out of the money SPY call to pay for the put hedge. But what if the SPY goes way up? How is that call protected?
Right. So the call would be protected by your actual stock portfolio.
Exactly.
Right. So if you have So if you have $100,000 stock portfolio and you have one call, that's actually a $37,000 ETF. About 37,000. So your stock portfolio would be limited in the amount of growth, but it would be only on a third of your portfolio. Mm-hmm. And if you're out of the money, you obviously have that amount to go. So let me, one of the strategies that I didn't get to throw in here, if you were to do that every week, if you were to buy 100 shares of SPY and then turn around and sell 1 week at the money call every week, you actually would make about 42% on average just by doing that. So you're not limiting it by that much.
Right.
If you do that. And in some cases, you're not limiting it at all.
That's incredible. That's incredible.
It is incredible. It's phenomenal.
And that's the thing. It is phenomenal. And the thing that you mentioned earlier is you got to make sure that you own the stock, and particularly if you're going to be working with the ETF on that.
Yeah, never, ever, ever, ever sell naked calls in any stock ETF ever. That's what I say.
You're not on the fence on that, I take.
Yeah. Nope.
All right. So let's see. Any other questions here? Why we have got Ryan with us? Once again, comprehensive presentation. It's rare to be able to get Ryan's time. You're a busy man, so we were delighted to have you here. You've got a fantastic offering.
I appreciate it.
That's available, and you're obviously very excited about this. Let me ask you this. There's a question I've been posing to the other presenters, and that is the theme of this presentation was return of the bear ? Do you have any sort of thoughts, external thoughts about what the market might do? Number one. Number two, do you really care? And how has it impacted decisions that you make in your trading and investing?
Yeah. Oh, my general approach is that I don't want to care. I don't want to have to try and be right on the timing. I don't want to have to be, try and interpret all the different political junk that goes on all the time. So I just put myself in a position where I'm going to make solid, decent returns if stocks keep going up or are stagnant for that matter, or even slightly bearish. But if the market crashes, I'm covered with my hedges. So I don't even worry about that. And so I don't put a lot of time into trying to time the market or, be a doomsday person. I'm not. I always say the government can kick the can down the road a lot farther than you ever thought they could. So they can keep pumping money into the stock market, indefinitely. Eventually it will come down. That's my thought. Eventually it will come down. When it does, I'm going to be prepared and I'm not trying to time it. So.
Sure. And I think that's great advice. And I think everybody here in the room that's listening can appreciate the kind of peace of mind that would bring to you, is to not have to sweat it.
Been in this too long. Don't want to sweat it.
Excellent. Ryan, thank you so much for your time. I hope you have a great day. It's been a pleasure
again, Raleigh.
having you with
Appreciate
us.
it.
Thank you,
my pleasure. All my pleasure. Thanks, Pat.
So folks, once again, that was Ryan Jones with Quantum Charts. And just want to, just a tremendous job there. He's put together an awesome offer for the Wealth Builders monthly subscription. That includes, the Hyper Options program, 2 live trading webinars per month. the special C4 strategy with the 2 live trading webinars per month, triple play options, 2 live trading. You know, he just, once again, an awful lot that he's packed around this vision and this thought that he has on the best way that you could protect yourself against the kind of volatility we could be seeing in the market. The offer link for that is westmarktrading.com/Jones. So please check that out. And any questions that you have, you can direct them to Ryan and his team. I think there's a phone number that's been put in the chat panel for that as well. So I encourage you to address any questions, further questions you have specifically to his team. And with that, Pat, we are right on time. I love it when the trains run on time.